one can argue that a lot of these model portfolios that worked over the last 10, 20, 30 years, whether it's the 60-40, risk parity, are no longer going to work in the future. So how should investors think about how to invest in a high inflation environment? How can they diversify their portfolio well?
Yeah, so I think it's important to contextualize that for the last 40 years, really going back to 1981, when interest rates were around 20%, you had a regime where stocks and bonds were inversely correlated, right? So as equities, anytime there was an economic downturn, the result would be the Federal Reserve and global central banks would come in and they would lower the cost of capital to ease financial conditions. What this did was it actually, when you lower interest rates, bonds and interest rates are inversely correlated. So the value of your bond portfolio goes up, and as the cost of capital goes down, other assets respond positively, right? Money is cheaper. So anytime equities saw a downturn, bonds saw an uptick. So this risk parity, this is kind of coined by Ray Dalio, a billionaire hedge fund manager, one of the most successful ever, kind of made his career on this trade of stocks and bonds being inversely correlated. And so 2021 happens, the everything bubble, the sovereign debt bubble, global debt levels are higher than they've ever been before, and now this inflation seemingly came out of nowhere, right? So now we have a stock bond correlation crisis where everyone floods to fixed income or is fully allocated to fixed income, and there's no protection in sovereign bonds. So I think really what we're seeing now is it's a sovereign debt bubble unwind, and even if in nominal terms bonds appreciate again, what's happening is we've already seen the peak of bonds in real purchasing power terms, and I don't think really people fully comprehend the implications there of bonds as fixed income as an asset class, basically offering negative real yields going forward.
Yeah, and that's so important to negative real yield, right? And one of the things that shocked me is just the volatility of these bond yields and the movements there, and the Fed, how aggressively they're going around this hiking cycle. And so, Preston, what does that do for the real economy? If I am an entrepreneur or a business trying to plan and model out into the future, how are operators supposed to perform economic calculations and allocate resources effectively in this environment where the money is being manipulated so aggressively and so fast?
I think the simple answer is they just build risk premiums into the price of everything to try to offset that risk. But let's pause there. Let's talk about how, when you look at models and you talk about all your models are destroyed, branded by Michael, which is completely 100% accurate. All the models are destroyed because when you talk about at the crux and the keystone of economic calculation, it starts with inflation. And when you manipulate the cost of capital for 40 years, what's happening that's not discussed in the actual economy is what you're doing is you're destroying competition because you're stepping in and you're having market consolidation happen in the quote-unquote free and open market. And what that does is it removes the biodiversity of competition amongst vendors. So let me give you an example. Maybe you had 10 companies that used to supply part widget A, right? So over time, over 40 years of these types of activities, it goes to 7, it goes to 5, it goes to 3. And now one of those 3 vendors gets killed. Now you only have 2. Well, all your models for just-in-time supply chain management that were optimized for Lean Six Sigma or whatever operational metrics you want to use for these super hyper optimized low-cost ways to do business and connectivity amongst the world starts to break down. What happens is you don't have 1 or 2% inflation for the things that most people are accustomed to going out and buying, and it starts to creep in, and then that compounds, and then all of a sudden you're not dealing with 1 or 2% inflation in this basket of things that people were telling you to look at. You start seeing 5%, then you see 8%, and then it starts getting to the point where, my God, is it going to be 10 or 20% next year? And so that's how it arrives out of quote unquote nowhere, is because a lot of the financiers are talking about things, but they're not talking about what's actually happening at the grassroots and at the small business or mid-cap business level with respect to supply chains. So then when you're talking about economic calculation that's being constructed off of this idea of quote unquote inflation, and you're doing free cash flow, you're doing free cash flows on top of inflation and hurdle rates of inflation, you can see how all your models are destroyed at that point. And that's hard for a lot of people that don't have a degree in economics, maybe aren't actually an operator or managing a large company, to be able to see both sides of this and to see why the bond market, as James described in great detail, is completely unwinding itself. And I don't know that, people talk about the end game. Are we in the end game?
I would say
Maybe
that
we are.
we have